Hi, everybody. Jens Johansson from J2 Building Consultants. Today, I'm going to talk to you about insurance coverage and the common question we get about if I file a claim with my insurance company, will they drop me? And so this is a common question we get all the time. And this video is going to cover the facts, the myths, and what you can do about it, and how you can use your insurance policy as a tool for which it's designed for. But first, give me 20 seconds on the background and insurance history here. So insurance or risk shifting is as old as mankind. I mean, think back to the caveman, their hunting parties. They assembled 6 to 8 hunters to protect the one hunter from being gored if his bow malfunctioned. Later on, when we got into shipping, we would break the cargo shipments into groups or multiple ships, to prevent losses from pirates or one ship sinking in a storm. The insurance policies or contracts, as we know them, came into effect in the 1300s in Italy. That's some of the first stuff. But underwriting and the process of putting together investors or money behind these things came into effect in London in the 1600s, where ship merchants again would meet up in the local coffee house run by Edward Lloyd and seek investors to pool their money to cover this particular shipment to the New World. And the coffee house charged a fee to write up the deal and hold the investors' money, which became Lloyd's of London. Fire insurance came about in 1666 after the Great Fire of London, which destroyed 13,000 homes and left 100,000 people homeless. Life insurance came soon after as mathematicians figured out the life expectancies and mortality tables, and we could predict how long you live. And so this is why your rates go up on insurance the older you get. So this concept became a pool of many get together and cover the risks of a few, because not every ship sinks, not every bow malfunctions. You get that. So that history is kind of fun. So I'm going to take you over, remember physics. So the physics classes and the law of energy. Insurance risk is like matter or mass. So that law of conservation of energy, Google it, states that matter or energy cannot be created or destroyed, only transferred. So this is the same as the law of risk. Risk cannot be created or destroyed, only shifted. So insurance policies shift the risk of the covered event for a fee, also known as the insurance premium. So modern insurance has evolved more to feel like your individual rating is exposing us, the insurance company, to more risk. Therefore, we're going to 1, increase your fees, 2, not renew you, and 3, we're not going to insure you at all. And so your individual rating is based on your risk, your claims to date, and if we, the insurance company, even want to be in this industry of property insurance or auto insurance or all their little lines, or be in this geographic area anymore, and I'll get into that. So specifically for condominiums, they look at, are you a new building or an old building? Do you have lack of maintenance, or do you keep everything up to date? Are you built out of steel and concrete that typically don't burn, or are you wood construction? Are you in a lawsuit-friendly state like California, New York? Are you in a storm or fire state like Florida or California? Think big, hurricanes and big fires. Do we, the insurance company, even want to be in this market anymore from a business perspective? All of our other lines of insurance are making money except property. Maybe we should just focus on auto, or, how much competition do we have in our area, et cetera. There's a lot of insurance companies here, and we can't charge the rates that we can in other states. So there's actually stories of condo insurers pulling out of markets, and whether by design or whether by waking up and realizing you're the last one standing offering condo insurance, what do you think happened to that company's rates? There was nobody left to insure, so they raised their rates and they got all the insurance business. So they're taking on that risk and providing you insurance coverage for that. So kind of this risk reward. So here's some insurance policy facts. Number one, the insurance policy is a contract to provide coverage for definable risks and events. Number two, this contract usually runs 1 year. That's called the coverage period. Number three, this is a free market, and they don't have to offer you renewals, and they can change their rates and so on. And since this is a pretty big gray area for potential abuse, each state established an insurance commissioner to oversee this insurance commerce and determine if companies were being compliant and reasonable within the rules. Insurance companies are primarily state regulated, but after the 2008 mortgage crisis and even the 9/11 disaster and other world events, the Dodd-Frank Act in 2010 established the Federal Insurance Office and the Financial Stability Oversight Council. So while it doesn't necessarily get into insurance policy stuff, it primarily watches if insurance actions can affect the US financial system inside the Treasury Department. So remember that phrase, too big to fail. That was because there's actually insurance companies that insure other insurance companies. And so in this, in these big storm events or big 9/11 events, there's actually one insurance company up there that insures everybody, and if they go out of business, they're too big to fail. And so that's where the Department of Treasury may come in and bail them out or offer support, et cetera. So that's the federal side. Number four, lawyers get involved in everything. So policies are challenged, state and federal rules are enacted or changed. The way courts decide or rule on things affects coverage. Some states are insurance friendly, others are, or insured friendly, I would say. Others are insurance company friendly. Some insurance companies sell in all 50 states, so federal court rules apply versus just state rules. So there's lots of state and federal regulation and rules around that, and lots of lawyers to get in the middle of that. Number five, insurance companies are for-profit companies. They pay out money when bad things happen, and they make more money when they pay out as little as possible. So there are lots of risk areas to manage: property or risk, location, rules, regulations, laws, market, the overall economy. And that's how they set their premium to cover these risks. So they diversify as well. Remember breaking the cargo into shipments. They have different lines. So they're auto, home or property, life, renter's insurance, business insurance, contractor's insurance, pets, geographic locations, you name it. So there's some companies that only insure engineers. They don't insure contractors. Their thought is that engineers are more methodical and less risk averse. Some companies only insure apartment buildings, not condos. Like I said before, some companies don't work in various states. So what happens to that company that insures contractors who work on condominiums in California? So you can see, these are for-profit companies. They're making their own business decisions and they're setting their rates accordingly. Number six, when big disasters like these floods or fires occur from big storms, the insurance companies are taking a big hit and they need to recoup those losses through changes in their coverage and rates. Number seven, they use statistics and actuaries to calculate risks and premiums. So this is why young male drivers pay more for auto insurance. Or maybe the zip code you live in has more accidents. This is because the statistics show this higher level of accidents, either in this age category or male, female, or even by zip code. Number eight, the policies and coverage limits evolve too. Like I said, these are 1-year contracts. So every year they get the chance to change their contract and rates and exclude the things they paid out on last year. And so, or include things, exclude things, change rates. So a good broker will help you review these limits and premiums and let you know that, hey, last year's policy, you had this coverage, and this year's policy, I can't get any coverage for that. So you'll see that in the health insurance as well. So we see some of the things our clients used to get coverage on has been restricted in newer policies. So things change. And number nine, you can buy policies on a per project basis, such as builder's risk or a wrap policy is common for new construction or large projects, and even larger rehabs. So let's get into the myth section. If I file a claim, they will drop or cancel me. It's not true. It's one data point of many, and most of which have no connection to your property. Remember the risk, the location, the lines of insurance. They can only cancel you midterm for extreme reasons, mid-contract, I mean. So like fraud, if they determine you're fraudulent, or non-payment, and a couple other little things, but they must give you lots of notice. But they don't have to renew you after the policy period is over. So number two myth, if I file a claim, my rates will go up. It's more easily understood based on that individual rating. But what about the rate increases on no claims clients for years? We've all experienced that in our auto policy. Had a perfect driving record for 20 years. Why do my rates keep going up? Well, that's rate increases are more linked to the economy. Costs go up, other business unit performance, these market shifts, more or less competition, more profit goals. So again, not so much related to your 50 unit community. Number three, if I file a claim, my current policy will be affected. Not necessarily true. Many claims are filed on older policies that were in effect at time of loss. So this damage didn't start this year or this policy period. This defect or condition or damage was actually created at time of construction. So sometimes, 10, 15, 20-year-old policies are in play versus your current policy. So again, it's based upon the language they use there. Number four myth, my contractor's out of business, so there will be no coverage. Not true. The insurance company is not out of business. And so we hear that one of, I know my contractor's broke, so there's no insurance coverage. Wait, stop. The insurance company's there. Number five, that's not covered under the policy, also known as a denial. This is a big myth with some truth. So how that's broken down is there's a saying or even a rule, depending on what state you're in. If it's not excluded, it's included. The courts said to the insurance companies, you have a building full of attorneys, and you have the chance to create and craft your policy to exactly what you want it to say, and then sell it. So if you miss something, we consider it included. So this varies by state, but it's something to be aware of. So you'll see the list of exclusions, and just remember that phrase. It's not excluded, it's likely, or it is included. So this gets into policy interpretation of states and the laws of your state. So working with an insurance experienced attorney is key. Denials could be part of a strategy to see if the insured just goes away. Remember, pay out the least possible. So we just get them to go away, that claim went away. So there are reasonable denials, as in non-covered or excluded items, and then there are unreasonable denials. I mean, if the company's not following the rules, this could put them in a position of what's called bad faith. And so consulting with an attorney is important to handle that. So how to think about and use your insurance policy. Number one, we want you to be honest. Don't commit insurance fraud. There's no magic insurance lottery jackpot handle. And if you are fraudulent, it can include big financial penalties and potential jail time. So number two, you have purchased a policy to protect you against known risks. So if you've experienced a covered loss, use your policy. That's what you bought it for. You've paid the premiums for the coverage. You aren't scheming or playing any games, and they've set their rates accordingly to pay for the covered losses. So use it when you need it. Insurance coverage and denials are really full of urban legend, which are a result of past experience, friends' experiences, and your actual policy coverage, which are similar but different. So be careful about listening to friends that haven't read your specific policy before determining your next step. Meaning, my sister's in-house counsel at ABC Company, and she told me they wouldn't cover that. Well, is ABC your insurance provider, and has your sister read your policy and things like that? So just watch out for the urban legend. Number four, use discretion and absorb the little things, but seek coverage for the big things. Sometimes deductibles and insurance process are a pain in the neck. And here's what I mean by that: the claim costs, the deductibles, but I pay for insurance. And it's like the difference between your deductible and your settlement is really this much. And how much is your time and energy worth of just paying it and moving on and then not having a claim on your file? So absorb the little stuff. Number five, understand that you may be the perfect client and still have your rates raised or insurance canceled without any claim history due to the other data points we talked about that your insurance company has to manage and we discussed above. So number six, understand there are lots of insurance companies and even brokers to help you find policies that suit your needs. So just because you don't get renewed, go back out to the insurance market, run those ads, for a new policy. You should be shopping around for cost and expense control anyway. So just keep going with that. It's not the end of the world if your insurance company comes back and says we're not renewing you for whatever reason. Number seven, you will likely pay more if you have an older rundown building. So keeping your building maintained and in good shape and having evidence of that is key. We've done other things on insurance companies now are actually requiring inspections to make sure what they're covering or what they're providing insurance on is a good in shape building. Number eight, if you're experiencing lots of claims recently, a pattern such as pipe bursts, freeze issues, fires, things breaking down, you may have a bigger problem that warrants repairs or upgrades. Maybe your plumbing system is failing, and that's a cost of property ownership. So watch out for the patterns. Number nine, an insurance claim is not the same as litigation. It's usually just filing a claim, which is paperwork and going through the process. So think 2 months versus 24 months. Now, when there's a dispute on coverage or denials or things like that, then that claim may move to litigation, but filing a claim is a common insurance policy business practice. So usually pretty fast. Number 10, coverages and denials are full of gray areas and even loopholes. So this is where an experienced insurance coverage attorney is worth hiring to find out if coverage exists. So in summary, your insurance policy is a valuable tool to mitigate risk for your property, and it should be valued and treated as such. It's a valuable tool. They're complicated. They can be confusing. They can put you to sleep. So you need someone or even a team that understands these policies and coverage issues, including your consultant, your manager, your attorney, and insurance broker, as both a planning tool before any event and as a management tool, before, during, and after the event you're seeking coverage for. So denials or filing a claim does not equal policy canceling. So hopefully this was helpful. We'll put this PDF in the comments, but insurance coverage, it's a fun thing. So thanks for listening.